Welcome everybody to the Q4 Jacksonville Real Estate Rental Market Update presented by JWB. I'm your host, Pablo Gonzalez. With me, as always, is the man that I like to host the Not Your Average Investor Show with here every Tuesday and Thursday, and which I affectionately like to call GC because of his genius concepts, because he knows how to generate cash flow, because he's a great co-host, and because his name is co-founder of JWB, Gregg Cohen. Say hello, Gregg.
Hello, everybody. Great to be with you today.
It is good to be with you all today. This is a call where our worlds collide. Our audience that shows up in our community, that shows up to the show every single week, interacts with clients that don't get a chance to come to all of them, but we know that you make time for this. We know that this is one of the most viewed episodes that we put out in a podcast, in YouTube form. It brings out the best in Gregg every single time. So super excited to kick this thing off. And we have a little tradition of how we normally kick this thing off, right, JC?
Yes, we do.
Yeah,
we must continue the tradition.
We must continue. We're going to do a live version of the roll call, baby. We've got the Maven from the mountains of Denver checking in already.
Leslie Wilson first off the bat here.
That's
I
right.
like that.
That's right. Our usual leadoff hitter batting second today.
John Henning.
Our good friend from Arkansas with a very quarterly update.
He's so
good morning.
kind. He's so kind being from Arkansas and how they beat up on the Gators. Denny Davies, good to see you, my friend.
Denny, good to have you in the house. We got the MVP of the community as usual.
Lee Bishop.
Everybody's heard of him. We got Mike McLeod. He's back.
Yeah, a long time client. Great to see you, Mike.
Good to have you, Mike. Who else we got? We got Walt Hart from Middleburg.
All right, Walt.
Checking in, Walt. Good to have you back. Glenn Shenkin from Massachusetts.
Long time client as well. Great to see you,
Good
client.
to have you. We got Layla Powell, a teammate in the house.
There we go.
We got the fairy godmother of our Not Your Average Investor Show community.
None other than Miss Jen Filson.
Back from her European vacation. We got Pamela Myers is back from the Seattle area. We got the mountain man,
Billy Green.
Billy Green from the mountains of Colorado. We got our favorite name to pronounce, Aaron O'Neill.
Into the Lights.
We love it when Aaron shows up around here. We got Pedro Nacianciano from
Jersey.
We got the shaman of the Not Your Average Investor Show community.
Nadeem Shah.
We got our regulars, Gary and Rosalind Riley from Marietta, California.
We regard you.
Good to have you in the house. We got Jeff from Maryland checking in. Good afternoon, Jeff. Good to have you in here. We got Laura Colby in the house from Washington State. We got Misty Johnson from Colorado.
Past guest of the show, past star of the show.
Jeff Pettijohn from Missouri.
Fantastic.
Great roll call today. Hello from Northern Virginia. Not Your Average Guest. If you're checking in from your phone, from a text, it just shows us Not Your Average Guest. So let me know who you are. We got JC checking in with a good morning.
Love it.
And we're going to right along Raj in the house.
All right.
Raj Bantu.
What a great group.
Great group. We got a lot of our regulars. We got some of our clients in the house. GC, normally you come into these calls with an intent. So I want to kind of give you the floor of what you want to talk about today, what you're thinking about.
Well, I always take a lot of time to reflect, especially before this quarterly call, right? I really want to make sure that there's time spent, not just looking at the numbers, but connecting with where everybody is in their place of the investment world or the economic landscape and what's going on in the thoughts and minds of our clients. So this can bring great value. When I started to think about what's going on in my head, it starts with gratitude. You know, we're in the season of gratitude here.
Yeah.
And to be able to sit here, we're on the cusp of our 18th year in business. It'll happen on January 6th of 2024. That'll be our 18th year in business. And to be here with you, to be here with all of our clients. Generally, we have hundreds of folks that are on the call here now. And to be able to have this platform, I am so thankful. And none of this happens without your trust. We have over 1,600 clients now who trust us, many of whom I haven't had the pleasure of even shaking their hand yet, but they trust us with their money and you trust us with your money. And I am so thankful that we have this opportunity to build this organization the way that we dreamed. And it comes from all of your trust. So I want to say thank you. You all have demonstrated that this model is successful over almost 2 decades now. It's been 18 years and you all have demonstrated this to the tune of over 3,000 rental properties that you have purchased with JWB. Because of that, we get to provide housing to over 5,800 residents here. And there are literally tens of thousands of people that come together to support this mission of doing what JWB does. And so I'm so thankful to all of you, to our extended network, our extended client list, because y'all are the reason that Pablo and I get to sit here today. And there's the reason why these 100 folks here at JWB are so inspired to do what we do. So that's where my mindset is coming into today. That's where it was all weekend as I was preparing. Extreme thankfulness and gratitude for giving us the platform and the opportunity to do what we do.
Awesome. Awesome. Season of gratitude indeed. I am grateful that I get to share the seat with you, that we've got to build this community out here, and that this has taught me to become an investor in this and build my own wealth through here. So
How about that, huh?
I'm grateful for the 18 years that you've been in business as well, my friend,
There we go.
and all your knowledge. That being said, in the spirit of gratitude, we want to make this as valuable as time as possible. We do not take lightly that you just took an hour out of your day to spend time with us. We're going to jump into this as quickly as possible, but to make it as valuable for you as possible, we want to make it as interactive as possible. So we welcome your questions. We have a bunch of data. We have a bunch of perspective. We have a bunch of advice to give out here, but we want to tailor it specific to you. So if you use that Q&A function that you see at the bottom of your screen, pop that open, put it in there. Don't put it in the chat, put it in the Q&A, because what we're going to do is we're going to run through as much of this information as we can. We're going to answer questions live on the show, but anything we don't get to live on the show, your portfolio manager will send it to you personally when we answer it. And we're either going to answer it today and send it to you, or any spillover questions. Our Thursday show is going to be our questions asked on the update that we're going to do, which we started last quarter. It was a phenomenal success, led to a really, really good Thursday call as well. Super interactive. So make sure that you use the Q&A function. And if you ask a question, be on the lookout for an email answer in the form of a video response from Old Genius Concepts over here, Gregg Cohen.
There we go.
That being said, GC, talk me into it, man. What are you seeing in the market right now? What is top of mind?
Well, for those who attend the quarterly real estate update, you're going to kind of see a trend here. I bring the same type of indicators to share with you because I want you to be able to measure things. You want to be able to look for certain things when you're thinking about how your money is performing. And I want you to see the same things over time, because that way is going to bring confidence and stability and education as to how you know your money is performing. So we're going to start the same way that we started, the last few quarterly calls. We're going to take a look at pricing. Okay. I get a lot of questions about what's going on in pricing. What's going on in pricing? A lot of insights that you might not necessarily have as a not your average investor, which is what our clients are, versus what you may be reading in the headlines. So let's take a look at pricing here in Jacksonville, Florida.
All right. We're going to share our favorite chart here. And GC, I think we're going to go into a speaking point that you had addressed early, almost over a year ago. You started talking about this.
Yeah. It's really fun because I actually went back and looked at our quarterly real estate market updates a year ago and 9 months ago. And the first thing that jumped out to me was the headlines that were out there at that time. And I shared those headlines with you, and the tone of the conversation was very different. As you're looking at pricing here, for those who aren't familiar and might be joining us for the first time, this is a graph of all of the median home sales prices in Jacksonville, Florida. The blue line is every median home sales price on a monthly basis going back to 2001. And that red smooth line that goes right in the middle there is the median projected home sales price. And that's based on what the average home price appreciation has been each year in Jacksonville, Florida. And so what you see here is really over the last year or so, you saw some fluctuation. And a year ago, we were right in the middle of those prices going down, down, down. And I'm sure you all remember as well, the headlines everywhere were calling for the crash, the real estate crash that had to happen out there. And we, in our own little small section of the internet here, in our small but mighty client list of 1,600 plus folks, we shared the message that we did not see a crash happening. We saw normality happening in the real estate market. We saw that the fact that prices was going down is actually normal. It's called seasonality. And we shared data to show that, listen, almost every single year for the last 20 years, home prices went down from June to January, which is exactly what happened here. And so we were one of the only ones to say that we fully expected home prices would bounce back up.
That's right.
And what do you know here? For the last year, you look at it, home prices in Jacksonville are largely flat, which is exactly what we said, and exactly the value of looking at data, having perspective, and having an insight that is not normal and not average, for the marketplace. And it pays off pretty well for our clients.
Yeah. And I remember you not only predicting that seasonality would take place, so there would be like like a dip that comes back up, right, to keep it flat for the year, you also had the foresight to know what headlines were coming. You were talking about, hey, watch this, right?
Yeah.
This is what you're going to see. We saw those headlines talking about month over month, and they were talking about the month over month decline and predicting this next decline or whatnot, right? So how has that matured out in your eyes, GC?
I'm so glad you asked. So I pulled some of the headlines here when I did a quick Google search of recent headlines, and look at the headlines that are out there now.
Look at that.
There was the great housing crash of 2023 that wasn't. And then, as home prices rose for the 6th month in a row, according to Case-Shiller, we were saying that you're going to see surprise in the marketplace that home prices are going up when there really shouldn't be surprise. It's called seasonality. When it's cold out and snowing in many parts of the country, guess what? There's less demand for housing because less people are out looking at houses. That's and right. Home values go down towards the end of the year, in the retail marketplace, not necessarily for what we do. But then when spring comes and summer comes, guess what? Home prices go back up. It's normal seasonality, and it's one of the benefits of being a JWB investor and a member of our Not Your Average Investor community, because we have that data, but we have perspective of doing this for almost 18 years. Yep. Right. And that's what you really need at a time like this to make effective decisions with your money.
So speaking of a time like this, and speaking of effective decisions to make with my money, I would assume that there is a majority of people that come to this call that are wondering if right now is a good time to buy. Is this a moment to wait? Is this a moment to buy? Is this a moment to hold? What do you think, GC? What do you think people are asking themselves right now?
Well, I think what people are asking, I think there's a general fear for how to invest right now. It is not as striking a fear as it was maybe a year ago, but there's definitely a general feel. People are uneasy. They have seen that real estate hasn't crashed. And so people are open to the idea of investing in real estate, but they're asking themselves, should I wait? Should I wait for home prices to come down? Should I wait for interest rates to come down?
Yeah.
So I started to think about this, and I'm like, well, those two questions are really good questions to ask. But I've been investing since 2006, 2007, and I have been met with more than a few really good questions to ask about whether or not to invest in real estate. So I started to think, and I think you guys will enjoy this, I started to think of all of the great reasons to not invest in real estate in Jacksonville, Florida, since I started to invest. And then I wanted to put some data behind it to show how that's worked out.
Got it. So we're going to put a little bit extra perspective, right? We're going to look at prices and interest rates and where they are right now, but we're going to look at the perspective in the sense that it's one thing to look at where we're at right now. It's also a good thing to look historically about the decisions that we would have made and how we would have felt making those decisions as well, because you've been doing this for 18 years.
And there's a reason why this asset class performs.
Correct.
It performs really well, even when there is a down economy. And so I looked at some of those times. Let's first start at 2007 to 2009. Just to put it in perspective, my business partners and I owned about 40 rental properties at that time. That was, 16 years ago, 17 years ago now. And that was a time when there was real fear in the marketplace. And I hadn't been through a full market cycle at that time. So I was going off of what the books told me and my mentors told me, but there was fear for me too. Well, I'll tell you how that worked out, right? At that time, we were dealing with the Great Recession. There was a housing crash. In Jacksonville, home prices were on the verge of dropping about 35% from their peak to their trough. And we had really high foreclosures. About 40% of all sales at that time were foreclosures. And, that's not a good thing for home prices, because when a foreclosure happens, it sells generally at a discount, and that weighs prices down. But, I invested.
I'm acutely aware. Yeah.
And I'll tell you how that worked out. So, and maybe this is news for most of you out there. Since then, from 2007 to 2022, even when you had all those reasons to not invest in real estate, all we've seen is an average of 4% rent price appreciation year over year, which is higher than the average, the historical average. All we've seen is home price appreciation of 3.8% year over year since 2007 to 2022. And then I started to put some dollars to this, because I wanted to show people how much money inactivity and indecision and not making the decision to invest has cost people. If you were to buy one property in Jacksonville in 2007, you would have pocketed about $155,000 just in appreciation of that asset. That's not even saying there's those other profit centers. It's $155,000 has been left on the table from people who did not decide to invest. Clearly, those are good reasons to consider, but the inactivity, not doing it, $155,000 on the table just for one property.
Got it. So that was the Great Recession when you were thinking, I can't be buying rental properties when the real estate market is crashing. Fair. That being said, inaction would have had this opportunity cost. Let's go to the next period where you would have been thinking, maybe you don't want to invest.
All right, 2010 to 2011, very high unemployment. I was even surprised, right? We're in an unemployment environment now, where it's extremely low in the 3% unemployment, even lower than that in Jacksonville. This was a time where we had nationwide unemployment of over 9%.
Yep.
Most people would say, I can't believe that you're going to invest in real estate if so many people are unemployed. But guess who continued to invest in real estate?
This guy. Genius Concepts.
Well, many people weren't calling me a genius at that time, I'll tell you that. There was new financial regulation, which makes it harder for banks to lend money. These are all great questions. Many people didn't understand how this was going to affect all asset classes. But all that's happened since 2010 and 2011, you've had an average of 4.1% rent price appreciation per year. You've had an average of 7.2% home price appreciation per year since 2010. And for those who made the decision not to invest, again, for reasons that are good to consider, but you would have left over $203,000 and forfeited that had you not made the decision to invest, even in those times.
There you go. Opportunity cost of inaction would have been missing out on this stuff, right? Even when it was high unemployment and new financial regulations. Next period where you're thinking about maybe not investing.
All right. So now let's go to the COVID pandemic, right? 2020 to 2021, there was a recession at that time, extremely high unemployment for some period of time. And there was this new thing that we had never experienced as an asset class before, eviction and foreclosure moratoriums. Paulo, can that be a good time to invest?
That was pretty scary. I remember those days.
Yes. But on this show, we talked about how this is a critical need. And if there's one asset class that you want to be investing in a time like this, you want to be investing in a critical need. And since 2020 through 2022, all we saw was an average of 9% rent price appreciation per year and an average of 15.5% home price appreciation per year. And just since 2020, if people had sat on the sidelines and did not invest like you invested, you invested in 3 homes since 2020.
I did.
Others who did not make a similar decision forfeited $125,000 roughly by not making that decision.
There you go. So again, inaction would have been letting, the opportunity cost was 9% rent appreciation. That's increased cash flow, 15.5% home price appreciation, and a nice chunk of equity that has happened in a very short amount of time. And then let's go to one more part where it's difficult today.
And here's where we are right now. Yeah. Okay. We're in high inflation times still. Inflation has come down. It's still high. We are in a high interest rate environment, relatively speaking, right? We have gone from interest rates in the 3%. Now for the average investor out there, you're getting closer to 7 and almost 8% interest rates. JWB clients get less. And that's shocking to many people. And there's another possible recession looming. So many of you, I'm sure, saying what is going on in your mind, but you're saying, how can this be a good time to invest? Well, since 2022, when these same conditions were in place, if you made the decision not to invest, you would have foregone 10% rent price appreciation. You would have foregone 9.9% home price appreciation in 2022. And you would have left $31,000 of equity gains. That's just from home price appreciation on the table. So my point here is that there is always going to be reasons to not invest. But this asset class shows over and over and over again its resiliency and its profitability, not just in good times, but in bad times. And it's hard to have data like that for the other places that you're putting your money. And that needs to be understood because now is a tougher time. It takes more courage to invest today than it has for largely the last 10 years. But certain asset classes are built to perform in bad times as well as good times, and most are not.
as I look at that chart that you put together, and I like this because we're going to get into today and what the conditions today look like and what that means for your investment banking decision. But I think illustrating that at all these different points, there was a reason to not invest, and you got to pass it through the filter of what happens historically. It really illustrates that thing that I keep hearing over and over again, that there's always a reason to wait to buy real estate, but what you really want to think about doing is buying real estate and waiting, because it works, right? And especially in this workforce housing asset class that is so well insulated in a growing market like Jacksonville, to me, that really, really illustrates the whole thing, because Jacksonville has been growing through the majority of that time, right? And this has always been the workforce housing stock that has always been undersupplied.
Absolutely.
Got it. Cool. So now to make a more snapshot decision, right? This was the zoom out. And now we're going to zoom in. We're going to look at it under a telescope now, and or a microscope. Either one you're zooming
I would say
in.
a microscope, telescope. I mean, that's like far out there. We're trying to get,
Yeah, you're right. Okay. So let's micro, not tele. We've talked about this. We had a recent show about this. What the pundits are saying right now, and when you really look at the data and you look at the conditions, it's not that this next recession is going to be like 2007 to 2008, because that was a very unique situation. But there is another situation that the numbers do kind of like mirror themselves. And it was what happened in the early 1980s. You want to just give us a real quick glimpse into what was happening in the early 1980s?
Yeah.
And we can start talking about, okay, now let's look at that data, because this is a good comp data.
Yeah, we had runaway inflation and in the late 1970s, and in the early 80s, we went into a recessionary period of time, but we had major demographics that were driving demand for housing. And that's kind of what we see right now, right? We had runaway inflation. In order to quell the runaway inflation, the Fed has raised the Fed funds rate, which affects all borrowing rates at every level of the economy. And so it's gotten more expensive to borrow for businesses and for people. And that is dropping demand for many asset classes, but it's dropping demand for housing. And the question is, what can we learn from the 1980s when it came to real estate? Because this market today is a whole lot more like the early 1980s than what many people are comparing it to. Many people are comparing to the early 2000s.
That's right.
But this is a very different market than the early 2000s. So I did some digging. Guess what I did? I started to get knee deep into the research.
Let's go.
And I just love comparing this and using data that is helping us understand where we are in this market. And we have a great comp, right? I'm really thankful that we actually started to get really great data really in the beginning of the early 80s.
Mm-hmm.
So I started to run the numbers here, guys. So from 1978 to 1982, and this is for all of the US, would you believe that home sales declined 50%? Home sales declined 50%, but home prices increased 44% from 1978 to 1982. And 82 is when the recession actually happened. So just take that for a second here. All of these headlines that you all have been reading for the last year and a half, and really, I see the headlines. I've seen it for the last 10 years of real estate has crashed. Real estate will crash. Real estate has crashed. It's all a variation. For the last year and a half, they have been talking about home sales volume going down.
Slow down in the market.
Slow down in the market.
Yeah.
Slowdown in home sales is not the same thing as a slowdown or a decline in home prices.
That's right.
It's very big to separate that. So you can have home sales.
Why is that, GC?
Well, whenever we're analyzing a market and we talk about a crash or a bubble or anything in between, we're talking about the value of the asset. We're not talking about the velocity of the trade. The velocity of the trade is the sale. But it's totally possible for your sales volume to go down, but your price or value of the asset to go up. But somewhere along the lines in real estate, people confuse that. It's the only asset that people confuse that about for some reason.
Yep.
And it makes the headlines. But it's very possible for you to have a big decline in an asset in terms of the number of sales, but the value to go up. That's what we saw in the late 70s and early 80s across the US. In 1981 to 1982, we saw a 10% decline in home sales volume, and we saw a 1% increase in home prices. If I had to guess, this is most similar to where we are today.
Yeah, 2022 to 2023.
Mm-hmm.
Okay.
And then the question is, what happened after that? Because once a recession happens, what does the Fed do, Pablo?
Generally lowers interest rates.
It lowers the Fed funds rate,
Okay.
which lowers all the other borrowing costs, which has an indirect effect on lowering interest rates. Why does the Fed do that when there's a recession?
Because when there is a recession, people are afraid to spend money, so they loosen up the money so
That's
that people can spend it.
They want to grow GDP. They want to grow the gross domestic product. They want to get the economy churning again. And the easiest way to do that is to bring more money into the economy. And the thing that they have the most control over is lowering the borrowing cost of people and companies. So the effect of it, if you're lowering interest rates, Pablo, what effect do you think that has on housing?
I would assume that it makes prices go up.
Makes prices go up.
Because it increases the amount of people in market looking for a home.
It increases demand.
Yeah,
absolutely.
Demand. Yep.
Because what's happened over the last year and a half, as interest rates have done the opposite,
correct,
they've gone up. What has that done to demand?
It has lowered demand.
It has lowered
because
demand.
now you're buying same amount of home for a higher monthly payment.
Exactly. Well, the opposite happens when you lower interest rates. And this is what we saw across the US from 1982 to 1986. We saw home sales volume go up roughly 57%, which makes sense because there's more demand because interest rates are lower. And then we saw 24% increase in home prices across the US from 1982 to 1986.
Interesting. So you said right here in 1981 to 1982, that's why you think that this is the period where we're just kind of like at or wrapping up, right? And you put a little bit of data behind that.
Yeah. I mean, in my best estimations, that's kind of where we're at right now. Okay. So then I started to look here local in Jacksonville. So from 2021 to 2022, we saw a 15% decline in home sales volume, right? The number of homes that are being sold in 2022 was 15% less than 2021. This is what made all the headlines. They called this a crash. That was not a crash. Because what we actually saw is home prices went up 36% from 2021 to 2022.
Got it.
And here's kind of where we are today. And that's why you can start to see some real similarities between 1981 and 1982. From 2022 to 2023, we've had a 7% decline in the number of home sales in Jacksonville, Florida, but prices are flat. Do you see a whole lot of similarities there between 1981 and 1982?
I do. I see a bigger decline and a bigger increase kind of like running up to it. Then I see a smaller decline with it basically like flattening. And then we see what happens after, right?
And this isn't to say that I think next year home prices are going to go up 24%. But what I know is that when we go into tough economic times, the first lever that the Fed can pull in order to increase economic activity is lowering interest rates. So if you believe that lower interest rates lead to home price appreciation, which is what we see over and over and over again, it should just make intuitive sense for you, then what we would expect to happen is that there will be significant home price appreciation in future years. And I don't know when that's going to happen. There's too many variables to know. But what we believe is that home prices will be higher over the next 3 years versus where they are today. And this is the biggest reason why.
Got it. So you were thinking that we are right now at that stabilization point. In the next short-term window is when stuff starts to kick up because the Fed is only going to hold the interest rate high for a certain amount of time. And it is only a matter of time until they start to lower the interest rates again. And as soon as that happens, we're expecting prices to go up. And you're seeing that in the short to medium term.
I'll give a little bit. I wouldn't go so strong and say it's only a matter of time. I do believe it's only a matter of time, but I don't know how long that's going to last. The Fed has made it very clear that they're going to hold interest rates high for an extended period of time. And that could all change tomorrow. They could see that and they could keep that for 2 years or maybe longer. But what I know is when they pull that back and they start to decrease interest rates, you're going to see home prices go up because simply there's not enough supply in the marketplace to support the demand. And if you start throwing more and more demand on something when there's not a whole lot of supply, you're going to see home prices go up at some point.
Got it. And what do you think the headlines say, GC?
Well, so these are started some of the headlines that I pulled, and you're starting to see, inklings of this from other experts in the marketplace. You're starting to read more articles about the lack of supply. Again, if you're a part of our Not Your Average Investor show and community, you've heard this for years now, but the headlines are starting to talk about how home prices have a high floor and simply are going to go up in future years because of the supply side of this equation, which we don't have enough supply to support.
And we do have plenty of data to have that lack of supply. And that is our favorite metric that we've been talking about here that you made famous. March 2020.
Again, I like to do the same things over and over so you guys can hold me accountable, can hold your decisions accountable, right? Get education through this months of inventory metric. Nobody talked about this a few years ago, right? I'm starting to see this more and more in some of the national headlines, which is really exciting.
You were like the Taylor Swift to Travis Kelce's MOI. You put it on the map.
Oh, goodness. I don't even know what to do with that.
I see the questions coming in. We're going to roll through this data, get to your questions as quickly as we can. So tell us about MOI.
All right. So MOI. So real quickly here, the way a great leading indicator for what home prices are going to do is the supply side of the equation. If you don't have enough supply to support the demand, you would expect home prices to go up. So in real estate investor expert speak, we talk about that as MOI, months of inventory. What we do is we take a look at how many homes are on the marketplace in your market here in Jacksonville, and we divide that by the number of homes that sold last month. And we get an equation. And if that equation is between 6 to 7 months of inventory, then historically that is an average home price appreciation expectation. You would expect average home price appreciation for your marketplace. In Jacksonville, average home price appreciation is 5% per year. If it is higher than 7, that would mean you have more supply than is needed to serve the demand, and you would expect downward pressure on pricing. That doesn't mean that you expect declines. It just means it's less than 5% is what you would expect over the next 6 to 12 months. And if it's lower than 6, you would expect the opposite. You would expect upward pressure on pricing, and you would expect prices to go up. And the lower you get below 6, the more pressure you have for prices to go up.
Got it. So that is the MOI disclaimer if you've never been to one of our shows or one of our quarterly updates, but this is where MOI is right now. GC, talk us through it.
Yeah. So I go back to September 2021, and you can see we had about 4,600 homes on the market. We had about 3,300 home sales in the Jacksonville market for a month of inventory of 1.4. That is about the lowest in history. Normally, MOI is right in that normal range, call it 6 to 7 months of inventory. So to be in the 1s and now in the 2s as of last year, September of 2022, is extremely low, and holding all else constant, you would expect home prices to go way up. The thing that it's seeing on the other side is the interest rates holding the demand down.
Interest rates holding down demand. And now in September 2023,
you have 7,000 houses on the market. So that hasn't gone completely bonkers. It's gone up as we would expect, but you still have over 2,600 home sales here in Jacksonville. Just to put that in perspective, in June of 2022, that was the first time in Jacksonville's history that we had over 3,000 home sales in a month. So months of 3,000 home sales is very unique for the Jacksonville market. We still had 2,650 home sales in September of 2023 with almost 8% interest rates for the average real estate investor or home buyer, which just leads to the question of what would these total sales numbers be if your interest rates were a little bit lower, if they were 1% lower or 2% lower, which is totally possible in the near future.
I think the story behind the story in these numbers you see, and I'm not the numbers guy, right? I am the feelings guy, but my feeling is that from September 22 to September 2023, interest rates went up and up and up and up and put a whole bunch of fear. Like that really, really slowed the market down. And I feel right now that interest rates are stabilized. Like right there, what they're talking about is that they're high and they're going to hold high. And the idea that during this rapid rise, it blipped up And then it barely nudged up again during this like really high rise. Feels like this number of like 2,500, 2,600 is just baked in. People moving here, people needing new homes in Jacksonville that are buying homes out of necessity, not out of opportunity. And I would have a hard time thinking that, we're not kind of stabilized here in MOI, at least in the short term.
I'll throw a couple differing perspectives there. So interest rates that closed in September were locked in, 1 to 2 months prior.
Okay.
So July, August is when those interest rates were in. You've actually seen significant increase in interest rates from July or August until now.
Yep.
So something to take into consideration there. So I don't really think we're comparing apples to apples there.
Okay.
And then the other side of seasonality is that you're going to see less home sales in November, December, because that's what seasonality is. There's less demand for housing. So I wouldn't be surprised if we have less home sales as we round out the year here. But then guess what's going to happen in February, March, April, May, June of next year, that number is going to go back up. So I think if you were averaging out our home sales, over the course of a year, I think you're probably right. But don't be surprised if home sales go a little bit down from here. That's part of seasonality. And that's part of the dampening of demand effect from the interest rate increases that the Fed has done, as well as the mortgage rate premium, which is something else to consider when it comes to an interest rate.
Okay. So that is supply data, right? That is upward facing pressure on home prices in the short term. We talked about, do I wait till prices go down or do I wait till interest rates go down, right? So that's pricing. It doesn't look like in the short term, it's really, really going to drop based on this MOI data. So if I'm on a plan and I'm thinking about buying a home or not buying a home because I'm trying to get to my retirement goal, it's not going to be pricing that does it for me in the short term. But there's a big one, interest rates out there. GC, what can we talk about interest rates on?
So interest rates is something that is on the minds of everybody. And so there are a few experts out there who are sharing what I'm sharing, which is, interest rates are high right now. Home prices are flat and holding steady. But, just think about what this market would be doing right now if interest rates were lower. So, our favorite shark out there, Shark Tank, Barbara Corcoran has come out and said, housing prices are going to go through the roof. And here's when. And she says the minute those interest rates come down, all hell is going to break loose and the prices are going to go through the roof. Right now, sellers are staying put. But they're not going to stay put if interest rates go down by 2 points. So I read this on Friday night and I was like, I wonder what has actually happened to home prices when interest rates have actually gone down 1% or 2%. So I started to put the data to it. So here is what actually happens when interest rates drop and the home price appreciation that has followed in previous years. And I'll tell you, I go back, I pulled this data from the Federal Reserve Bank of St. Louis. I think they had data all the way back from maybe the early 50s. It was a lot of data. There have not been a lot of times when the Fed has had interest rates up this high and then dropped interest rates at least a percentage point within a following year, which is exactly what we expect to happen when the Fed does drop interest rates here. It happened in 1982 and 1983. From 1982 to 1983, the average interest rate for a 30-year fixed rate mortgage dropped 2.8%. And then the year following that, you had 6% home price appreciation here in Jacksonville, Florida. 1984 to 85, interest rates dropped for the average 30-year fixed rate mortgage dropped 1.5%. The following year, you had 4.7% home price appreciation, which is more than the norm at that time here in Jacksonville. 85 to 86, interest rates dropped another 2.2%. You had 4.4% home price appreciation the following year. 92 to 93, it dropped 1%. You had 2.5% home price appreciation the following year. 2001 to 2001, interest rates dropped 1.1%. And next year, you had 8.9% home price appreciation. And then there's 1 year where it didn't apply. What happened there, Pablo?
We had a great recession that was caused by housing.
That was a great recession, guys. It was a little bit different. So what we're seeing here is that there is a significant correlation between when the Fed drops the Fed funds rate, which lowers average mortgage rates for everybody who buys a house, and home prices going up. So You can listen to Barbara from Shark Tank. You can listen to me, who has lived this for the better part of 18 years. But that is our thesis. And, and that's why, even though you have that discussion of home prices potentially in your head, you're like, maybe I should wait for them to come down. It's not going to happen as low as inventory is right now. The interest rates discussion, the best thing about interest rates is that homes cash flow today, even at an interest rate that is higher than you probably want. But then when the interest rates come down, all you do is refinance. And the numbers just get better and better and better.
That's what Dean Curry said here in the chat. The early bird, marry the house, date the rate.
There you go.
So you get in, you buy the asset, and when interest rates go down, you refinance and you get that infinite return kind of thing going, right?
There you go.
So one of the summary stats we put in here is the idea that it was 5 of 6 of the times that the interest rate dropped, it went up, right? In Jacksonville, 2 out of 3, it appreciated more than 4%, and 1 out of 3 actually appreciated more than 6%, right? So these are like really high numbers. The average home price appreciation in the following year after an interest rate drop was 5.3%. So GC, if I'm looking at these stats that you put together and I'm trying to figure out what's going on in your Genius Concepts head, I'm hearing there's upward pressure on pricing due to MOI and supply. And I'm also hearing that there is going to be a moment here in the short run that interest rates are likely to drop, which is also going to create upwards pressure in pricing.
Mm-hmm.
So am I out of line thinking that your recommendation is generally a good time to buy?
It is a great time to buy, especially considering your alternatives in the overall investment space. But this is a great time to buy, and it's because you have a high floor and you have upside. You have a high floor because of the low supply of housing that is going to keep prices stable, which is exactly what's happened over the course of the last year and a half. And you have significant upside because we do expect home prices to go up at some point in the relatively near future. It will happen when interest rates come down. And the reason why we see that as upside is because you can't fix the supply problem fast enough. You cannot build fast enough to a place where you don't have a supply problem, call it in the next, 3 to 10 years. And, we would expect that interest rates would come down somewhere before that time frame.
Makes sense. So that being said, risk mitigation and upside, right? What we love about this asset class, I'm hearing, if I'm thinking about it, don't, like from a historical lens that we just looked at, right? Like from looking at historical decision-making, then move forward with it. And seems like things are going to go well because you got that high floor, you got that upside baked in. That is from a historical perspective. Let's take a snapshot of what the actual numbers, what the housing numbers look like today, right? So this is present day, Jacksonville versus US real estate market stats.
Yes.
So this is going, you were basically just talking about like in a vacuum, prices are likely to go up in the short run because of these pressures. But this is how Jacksonville looks in relation to the rest of the US.
Yeah, absolutely. So we're going, not telescopic here. We'll go microscopic for this moment in time. You like that?
Whatever scopic you'd like, sir.
We'll go out of the theory here. In the US in September of 2023, our median home sales price across the country here is $412,000. So in Jacksonville, our median home sales price is $350,000. Across the US, you've got 33 median days on market. That means the days from the time that you list your home for sale to the time that it's under contract. And in Jacksonville, it's 34 days. Here's interesting, though. I put Jacksonville's performance 1 year ago to today, and I also put Jacksonville from 2019, compare that to 2023.
Mm-hmm. So
year over year, home prices have gone up a little bit less than 1% in Jacksonville. Home prices last September were $347,000. They're $350,000 for a median home sales price here. Our days on market a year ago were less than what they are right now, but and I think that would make sense. The market was completely on fire from all parts of 2021 and many parts of 2022.
Yeah.
But let's go back to 2019. Home prices, of course, were lower. $235,000 was the median home sales price in 2019 before the pandemic. And by the way, everybody thought investing in 2019 was a good idea, right? There weren't headwinds like there are today.
Yeah.
So, but look at that median days on market. You had 43 median days on market. I hear all the time this narrative that this is not a good time to buy a house or that the market is, slow or whatnot. In 2019, when everybody thought this was a good real estate market to buy, we had 21% more days on market than we have right now. And you all called that a good market back in the day. For some reason, now we have 34 days on market and people are saying that real estate, it's a bad time, or that it's slow, or that it's potentially crashing, depending on who you're looking at. So I think this perspective really does show that real estate continues to move, number one, because it's a critical need, and especially in a growth market where population continues to grow like Jacksonville, Florida.
Got it. Okay. So market, when it comes to Jacksonville, looking attractive in comparison to the rest of the US, right? Like right on par, medium days on market, still something that we talk about here, which is attractive. It is below the median home sales price of the United States, which means more upside as well. It means a attractive market to get into without having to bet the farm on it, as we like to call it.
Well, and it means positive cash flow.
And it means positive cash.
It means the ability to have an asset that pays for itself every single month, which is, you can't get that if you go to places like California, New York, Virginia. Many of our clients live there and they choose to invest here in Jacksonville for the reason that you see here, that it's lower purchase prices.
Got it. So that's the Jacksonville market versus the US market. Now let's talk about the actual JWB inventory, what it looks like right now.
Yeah, absolutely. So I want to give you a snapshot of what you can do to grow your portfolio with us. So whether you're a current client or a potential new investor, what you're going to see from JWB as we put a real estate portfolio together for you, your minimum investment per house is going to be roughly about $75,000. And that would include your down payments and your closing costs. And, of course, it will go up from there. Your return on investment will be between 9 to 10%. And your interest rates for JWB clients are actually much better than what's out there in the marketplace. We're able to get roughly 6.75% interest rates, which I know it's higher than it was a year ago and 18 months ago. But again, perspective here, the average interest rate over the last 30 years for a 30-year mortgage is actually 7.8%. So I know it doesn't feel good based on where we were a year ago, but again, 6.75% can produce an asset that pays for itself every single month and historically is actually lower than what we've seen. And then we do have a lot of clients that are taking advantage of what we have affectionately coined
bundles, baby.
Bundles. We've talked about this internally and I was like, we've never called it a bundle on our client calls or our quarterly real estate market updates. So I'm like, we're going to call it bundles here.
I'm into it.
All right.
You didn't have to get my approval.
It was originally, I was calling it the multi-purchase discount or whatever. I'm like, that just doesn't sound as great.
Nobody wants a multi-purchase.
So we all talk about it as bundles here internally. So bundles incentive, that's what we're going to call it. Yeah. So for those clients who, move a portion of their funds from other places or, build that plan and can purchase multiple homes at one time, the minimum of 3, what we do as an incentive is we drop $5,000 off of the purchase price for each one of those assets. And there's no limit to that. Client who just came on board, purchased 7 homes and had $35,000 taken off of his purchase prices because he was able to bundle it up.
Very nice. Very nice. All right. So that being said, this minimum investment of $75,000, that's because you're thinking about a home in the price range of,
$225 to $250 is pretty average for a JWB turnkey investment property.
Yeah, right. Which kind of falls in line with what we talk about, workforce housing. If the median income, the median home is $350, $225 to $250 is at that like 80% range, right? That's workforce housing.
Yeah.
So once again, even more risk mitigation, even more upside because you're at that lower price point as well. And if, again, we've looked at the numbers, we've looked at the historical perspective, we looked at the snapshot, looks like high floor, right? Because of how this thing has done historically in hard times, looks like baked in upside of a rate going up in the mid to near future. And that means that, again, if you are trying to build a portfolio for retirement, right? Like I think of the decision-making process of why I buy or don't buy. I think over the last year or 2 years, there may have been some like hawks coming around that we're never going to be in this asset class, but like, oh no, this might be the best time to buy ever. And they got in on it. I think the people that are on this call right now are folks that are just not your average investors that want to get to a retirement sooner, that want to get to a retirement with a higher lifestyle because you have this guaranteed cash flow and less fluctuations. If that is what you are trying to do, the idea of waiting it out, waiting on the sidelines, waiting for a price drop or an interest rate drop is probably not going to outweigh the benefit that you get to hitting your goal, and this idea that you're going to get in with a high floor, baked in upside. When the rate goes down, you can refinance it. But for the time being, you're doing well, you're investing your money, and you're getting that return. So any new client that wants to get into that conversation, you go to chatwithjwb.com. If you're a current client already on your plan, you know what to do. You talk to your portfolio manager. They're on the call. They're the ones that are going to be sending you the responses to these. We got over 16 questions in the Q&A.
Love it.
So I'm dying to get into these, but we talk about this all the time, right? This is the asset. The asset is great. The reason why you have success in the asset is because you are investing in a great team. So on these quarterly calls, we don't just talk about the market. We don't just talk about the assets. We talk about how the people managing your money are performing. So we're going to go over the JWB update so you can let us know how you are doing, GC. Let's go.
So proud of the people on the team here at JWB. I mean, these are tough economic times that we as a team, as an investment community, we've endured over the last 3 years. There's been a lot of uncertainty, but you know what's been very certain is the performance of our team, specifically on the property management side, to make sure that we deliver on the promises of the sales side for JWB. It's our team. It's that vertically integrated approach. And so they make it easy for me to get up here and share some of these really wonderful stats with you, which I do every quarter. So through September of 2023, our team has purchased 62 homes. And I included the private lending dollars that we've raised this year, because no reason that I haven't included in the past, other than I just thought the number's pretty impressive. And I want to give a shout out. So private lending is for all of you who lend to JWB for the purchase of us developing new turnkey properties or other developments that we do. And so if you're interested, you can of course reach out to our team specifically for private lending. But we've raised over $23 million just through September of just this year. In totality, we've raised over $300 million in our company history and paid every single investor back with principal and interest. So a big shout out to the lending team. Our team of new construction and renovations has prepared 297 investments, whether those are new construction or renovated homes, to become turnkey assets for all of you. And our sales team has sold 280 homes this year.
Major operation, right? Like 62 properties purchased, $23 million raised, 297 properties built, renovated, right? We had William here on the show.
Right.
Construction services. That might be, that's got to be one of the bigger single family home construction operations in Florida, at least, right? Like if not one of the ones in the country that aren't just track home builders. And then property sales, 280, right? Like a very significant sales operation as well. Talk to me about the property management arm.
Property management, what makes this asset work.
Yep.
And so our property management team has collected over 98% of rents in 2023, which is the exact same high standard that we achieved in 2022 and 2021 and 2020, all while going through eviction moratorium. So our team just continues to perform for you. And I'm so thankful that we have such a talented bunch. Our average rent per property continues to go up quarter over quarter. This is for our turnkey assets here. So the average rent for all of you out there who are JWB clients is about $1,429 for an average turnkey asset. And look at this number of current properties under management. I think it was 5,400 the last time we spoke a quarter ago. It's getting pretty close to 6,000.
Getting pretty close to 6K. That's really impressive.
We're buying a property management company to end the year. This will be our third property management company that we're buying, and that will push us over 6,000 properties under management.
Let's go. So 98.4% rent collection, average rent per property, $1,429. I remember when that was like close to like 1,000, right?
Yeah.
So rents keep going up, y'all. That is increased cash flow for everybody. Properties under management, to me, I see this as scale, right? Like I just see this as economies of scale. This makes you be able to be more efficient, invest more resources into the things that matter. It allows as a business owner to have recurring revenue and constant, like wither constant cycles that happen and be able to deliver time over time. And finally, last KPIs here.
Yeah. So our leasing team, just an incredible shout out. We're setting JWB world records across the board here. We've rented through September. We've rented over 1,200 homes. That number will go up significantly as we round out the year. And again, the most that we've rented in our company history, which you would expect as our number of homes goes up. But goodness, hard to say that you expect in one outfit to be able to rent close to 1,200 or 1,500 homes in a year. Incredible job by the leasing team. They're continuing to challenge challenge themselves to sign long-term leases, which is a bedrock of how we perform for you as a turnkey investor. The average duration of the initial lease is 26 months, which means that on average, people will be signing between a 2 and a 3 year lease on your homes, which is a great strategy for you to be able to see consistency in your cash flows. But lease resigns are just as important, if not more important, because once we have one of those residents in your home, we want to treat them like gold and we want them to stay for as long as possible. And so we focus on lease resigns, and our wonderful property management team has signed just about 1,400 renewals through September. So again, that will be a world record for our organization, all while keeping our eviction percentages in line with historical norms, about 0.4% of evictions per month.
There you go. That also answers Carlos Andres Lopez, aka Cal's question. What about eviction rates with a slowdown on the economy? You handled that one ahead of time.
There you go. It's right in line.
Eviction rates haven't really gone up, just like they didn't really go up during COVID either.
No,
right?
They didn't.
All that stuff, right? There's just a well-oiled machine that treats these abilities to, not just the lease signing as a negotiation to get people in between the 2 to 3 year leases, which is harder for a property management company, but better for an investor. But also you treat these re-signs, right? My parents were just in town. I was telling my dad about this. Like, you guys treat re-signing of leases as this entire unit that is devoted to like a sales team making this stuff happen. The pace of what that conversation needs to look like. How to do it in a way to get them to stay. You build a relationship when you need to, when you don't need it, so that you have it when you need it, and you get this amazing number of lease re-signs, which as an investor, for me, I see as consistency in my cash flow, minimization of hard times that happen when people turn.
Absolutely.
So to put a button on this before we dive into like maybe 1 or 2 questions, GC, give us the last kind of like stuff on the portfolio and what you can invest in right now. If you like the asset, you like the historical perspective, you like the market perspective, you love the team, because that's what you really got to love. Your minimum investment you're looking at here is in the realm of 75 grand to buy one of these homes with JWB. Estimated IRRs 9 to 10%, which in this economy is awesome.
Yeah.
Interest rates 30% down is 6.75%, which is surprising because most people are hearing higher numbers than that.
Right.
But you're able to achieve that because of your relationships and your economies of scale and stuff like that.
Right.
And there is a bundle incentive. If you've got 200 grand that you are looking to invest or looking to move into an asset with a high floor, high upside, and you want to buy 3 of these homes, then you're going to get $5,000 off of a sales price. And the way you do that, if you're a new client, is you go to chatwithjwb.com. And if you're an existing client like me, or like many of us on this call, you reach out to your portfolio manager. What did I miss? How did I do?
I think you did a great job. I think this is an important time for you guys to cut through the noise and realize that there is always going to be a reason out there that could potentially, tell you that this is the wrong investment. You could do that anytime. We've done that. We outlined all the major reasons since 2007. But when you have an asset class that has the resiliency and the qualities that we've seen decade over decade over decade, you've thrown anything at this asset class. And if you just simply buy and hold, you are rewarded for this asset class. And if you have a team backing you who is talented, who has lived through this investment for almost 2 decades, you put those combinations together and you're going to make wise choices with your funds. So I would encourage all of you, if you're a new client, reach out to our team. Let's start having some of these in-depth conversations. If you're a current client, you can make decisions today that set you and your family up for financial success and get ahead, whereas others might be left being a part of that slide that I showed early on, which was the hundreds of thousands of dollars that they left on the table simply because they couldn't cut through the noise.
Yeah, the vulnerability is in action here, right? It is not reaching that retirement age. You're not your average investor. You're not your average investor. You're tuning into this stuff because you know that there's a better way to plan for retirement in a way that gets you there faster, in a way that is more consistent cash flow that will allow you to have a higher quality of life more consistently when you are in retirement. And if you are listening to the noise, you may be delaying this by a year or 2 instead of just getting on it, right? Like making the moves that you need to make, making the tough decisions that people are going to question when you're doing them, and then look back 20 years later and be like, no, it was easy to do. It was, that interest rates were going to go down and things were going to go up. Right?
They're never going to call you smart. They're going to call you lucky.
At
just
the
so
time,
you know.
At the time. Yeah, exactly. GC 1:30. So we're going to answer these questions. We got 20 questions on Thursday. We're going to run through during the Thursday show. If you have your name in here, we will email you. Your portfolio manager will email you the video answer. We'll chop each one of these up and send it to you personally, or you can come on Thursday and be there and listen to it live. And if
let's choose one or two just to make sure that, right? Let's do that. I feel a little
taste, a little taste of what you can get here. All right, let's go with Jean-Paul Rousseau.
Jean-Paul, longtime friend, longtime client.
Phenomenal name. Phenomenal name. Long term, don't you fear negative impact due to climate change, more and stronger hurricanes, or sea level rise?
And I know you'll chime in, Pablo, because you're more of an expert on climate change than I am. I think it's something absolutely to take into account, right? Climate change is a big problem a big potential problem out there for many, many folks in many parts of the country. The way I look at that right now is for me to make the best decision with my money. And that's one of the factors to consider. But there's a reason Jean-Paul, and Jean-Paul he's a JWB client. And, I remember where Jean-Paul's homes are, right? Jean-Paul, your homes are not next to the Atlantic Ocean, right? Your homes are inland, right? 20, 30 miles inland here. And that's where, JWB's workforce housing neighborhoods are. And so while climate change is something to be aware of, it is something that we're aware of here, the fact that we are not on the ocean is a big deal. And so, I think our jobs as investors, again, is to make the best decision with the information that we have right now. And while taking into account climate change, I still think this investment makes a whole lot more sense than a lot of other investment decisions out there.
Yeah, Jean-Paul, and to that tune, I don't know if you've tuned into past shows here, but I used to be the director of sustainability for a big developer down in Miami, green building expert. I am very keyed in on the climate change thing. And what I can tell you is that the risk of climate change across Florida varies. And when you get south of Lake Okeechobee, there is a really, really big risk of climate change because it sits atop a porous aquifer. And what people are really worried about is that as the sea level starts rising, that river of water that goes underneath it above this like Swiss cheese rock is going to rise from, inland from underground. And there is no solution for that, right? So South Florida has a much higher risk of climate change than North Florida. And the risk that North Florida has is the risk any coastal town has. It's the same risk as Manhattan. The good news is that cities like New Orleans, cities like Amsterdam, they know how to keep the sea out from just like the ocean coming in when it's just coming in from one area. They don't know how to keep it out when it's coming up, right? So like, that is a very, very different risk of climate change up here that will affect all coastal areas equally. And if that's what you're worried about, I think there's a series of things that, are going to affect investments and investing and all those different things well before it starts to happen in this type of real estate that's inland, that's protected. Jacksonville has this like really good climate that has these like prevailing winds that allow us to not get hit by hurricanes dead on. So, that's always been a good thing. And I can just tell you that it's a very, very different conversation up here. And one of the reasons I moved here, for the record, because I believe in the risk of climate change so much that I believe that in Miami, my career could have been disrupted on the back end of my peak earning year. So I believe in climate change. I do think that it is something that we're going to start seeing the ramifications of it. I don't think that north of Lake Okeechobee is going to be affected any different than the rest of coastal areas and how they happen in our lifetime.
Well said.
That being said, let's do one more GC from a not your average guest asking, what is the percentage of homes under JWB that have not been rented out?
Our stabilized occupancy is kind of what we're asking. I'll do it in terms of, investor speak here. So you're looking at generally across the board, your vacancy rate for a property management company is about 10% at any given time. So you got 100 homes that you're managing, 10 of those are vacant. So 90% occupancy, 10% vacancy. Our vacancy historically has been a lot less than that. And our stabilized occupancy is about 95% right now. So we go from anywhere from about 93, 95, maybe a little bit higher than that for occupancy. So we're right in line with where we would expect to be.
All right. Last one. Anonymous attendee. Maybe he knows Simple.
Maybe.
Has a question. Love the rate buy down by JWB. Question. What determines the rate buy down? In other parts of the country, builders and turnkey companies are offering 5.5% rates.
We buy down as much as we possibly can. It's really interesting to me how others advertise that their rates are 5.5%. So I would question that. It is much easier for builders who own mortgage companies to be able to buy down rates of new construction properties, but I know for a fact that there are other turnkey companies out there that have 5.5% on their evaluations, 4.75% on their evaluations, and there's no possible way that they're able to do that. I know that for a fact. So I would absolutely question the mortgage rate that you see. It's one of the easiest ways to put an evaluation together that is appealing to the eye of a potential investor, but just flat out has no chance of ever being performed upon. So I would ask those questions, and then I would also ask them to show you reporting of how those clients of that company have actually performed over 5 years or 10 years, because I don't know of another organization who will be able to answer you with data. So we buy down as much as we possibly can. You're actually limited to 2% of the purchase price as far as the concessions that we can give you as far as a rate buy down. And that's how we determine that rate.
Over 120 people on today. Incredible attendance. Always get rewarded by our community, by the interested clients, by folks that are just interested in the Jacksonville market. And that JWB has kind of like the data flywheel that nobody else has around here, right? So really appreciate you taking time out of your day to be here, ask these great questions. Again, if you're a new person and you haven't already invested with JWB and you believe in some of the stuff that Old Genius Concepts is saying over here, and you don't want to slow down your retirement plan, go to chatwithjwb.com. Pick out a time to talk. If you're an existing client, talk to your portfolio manager. If you have a question in the Q&A, look at whatever email you use to sign up for this thing. Look in the next week for a video response sent to you by our team. Otherwise, you can come on Thursday and listen to him answer it directly to you, and or bring us more questions after you've thought about this. So hope to see you Thursday for an open Q&A. GC, I'll give you last words.
I'm just so thankful. Again, that's how we started this call. Incredibly thankful for you all being here. Hundreds of people spending time together. This community is special, and I love what the platform that you guys give me. I love pulling this data and putting the perspective together with it. It's a true joy. So thank you again for giving us this platform. Hope you all take this information, make really wise decisions, and continue to grow your portfolio with JWB.
I got to give you your flowers, GC. You pulled particularly good data this time.
Thank you, buddy.
I know that I was
pretty excited about it.
After the Dolphins lost to the Chiefs, I went over this presentation with him, gave him a couple more challenges, brought some more data, of course, because he is not an average show host out here.
There we go.
And the advice we've given you up until now, but I think there's a bigger piece of advice that we like to give everybody for you to do. What is that, GC?
Don't be average.
See you on Thursday.